Bitcoin is supposed to be digital gold, right? So here's the uncomfortable question. If Bitcoin is really a hedge, why did it crash together with stocks in 2020, 2022, and other big sell-offs? In this video, I'm going to break that myth down step by step. First, why Bitcoin has not been a good hedge against stock market crashes. Second, when Bitcoin actually can work as a hedge. Third, what could realistically push Bitcoin higher over the next few years? And fourth, a simple takeaway you can use in your own portfolio thinking. Let's get into it. First, let's be clear what a hedge is. If something is a hedge against stocks, it should go up when stocks crash, or at least hold steady when everything else is bleeding. But that is not what Bitcoin has done in the real world. Let's start with a very concrete example. March 2020. During the COVID panic, global stock markets crashed. The Dow Jones and the S&P 500 dropped more than 20% in just a few days. At the same time, around March 12, 2020, Bitcoin fell almost 50% in a single day. That is not the behavior of a safe hedge. That is the behavior of a high beta tech stock on steroids. And this pattern did not just happen once. In later sell-offs, like parts of 2022, you saw the same thing. When markets were in a risk-off mood, stocks went down and Bitcoin went down as well. Several studies back this up. Research from institutions like the International Monetary Fund has shown that since the pandemic, Bitcoin and US stocks have moved much more in sync, especially during periods of market stress. Some of these studies even found that Bitcoin's volatility can explain a noticeable share of movements in the S&P 500 during that period. More recent academic work after the launch of US Bitcoin exchange-traded funds shows that Bitcoin's correlation with major equity indices like the S&P 500 and the Nasdaq 100 has actually increased. As more institutions treat Bitcoin like part of their risk asset basket, it starts to trade even more like equities. So if you bought Bitcoin expecting it to be your crash insurance, the data is pretty clear. Historically, it has not worked that way. Why does this happen? Let me give you the intuition without any formulas. Reason number one, it is the same money and the same mood. The same funds, hedge funds, and aggressive traders who buy growth stocks also trade Bitcoin. When they de-risk, they do not just sell stocks, they sell everything that looks risky: tech stocks, small caps, and Bitcoin. Reason number two, liquidity cycles. When central banks raise interest rates and stop printing money, global liquidity dries up. Risk assets suffer. Bitcoin lives in that same risk asset bucket. Reason number three, leverage in crypto. Crypto exchanges often offer very high leverage. When markets panic, you do not just get selling, you get cascading liquidations as positions are forcibly closed. That is why Bitcoin often falls more than stocks on the worst days. So, in practice, during stock market crashes, Bitcoin has not been a hedge. It has been more like a leveraged expression of risk sentiment. When can Bitcoin actually work as a hedge? If Bitcoin does not hedge your stock portfolio very well, what does it hedge? To answer that, we have to go back to Bitcoin's design. Bitcoin has a fixed supply. There is no central bank. No single government controls it. Payments are peer-to-peer and resistant to censorship. That makes Bitcoin less like digital Visa stock and more like insurance against currency and system risk rather than day-to-day stock market volatility. Let's look at some real-world examples. First, hedging currency collapse and runaway inflation. Take Argentina as an example. Inflation has been extremely high and trust in the local currency is very low. Over the past few years, a very large share of Argentina's crypto trading volume has been in stablecoins, mainly dollar-pegged ones. For many ordinary people, crypto is a way to escape a fast devaluing peso and move into something tied to the US dollar. Most of that hedge happens through stablecoins like USDT and USDC, but Bitcoin is part of the same survival toolkit. It is a way to exit a failing currency and move value into something global and harder to control. In this context, Bitcoin is not hedging the S&P 500. It is hedging your national currency. Second, Hedging capital controls and restrictions on moving money. A recent working paper from the International Monetary Fund on Bitcoin cross-border flows found that Bitcoin activity is correlated with incentives to bypass capital controls. In simple language, when governments make it hard to move money out of a country, people increasingly use Bitcoin and crypto rails as a side door. That means Bitcoin can act as a hedge against your bank account being locked, against sudden capital controls, or against restrictions on wiring money abroad. Not because the price always goes up, but because the network continues to work even when the traditional financial system says no. Third, hedging payment system risk. There are many places in the world where a large part of the population is unbanked, pays huge fees for remittances, or relies on fragile and expensive banking systems. El Salvador is the most famous experiment here. In 2021, it became the first country to adopt Bitcoin as legal tender and heavily promoted a Lightning Network-based wallet for everyday payments and remittances. That experiment has been controversial. Bitcoin use for everyday payments in El Salvador is lower than the initial hype suggested, and the International Monetary Fund has pushed the government to be more cautious about its Bitcoin policies. But the core idea is important. Use Bitcoin and the Lightning Network to send money cheaply and instantly, especially where banking and card networks are expensive, slow, or unreliable. Globally, Lightning adoption has been growing. By 2024 and 2025, various datasets showed millions of Lightning transactions per month, and some payment processors reported that the share of Bitcoin payments going over Lightning had more than doubled compared with a few years earlier. In that sense, Bitcoin plus Lightning can hedge against things like, "My bank is down," "Visa does not work here," or "I cannot open a brokerage account, but I can still use Bitcoin." Again, this is not price insurance. This is access insurance. Fourth, hedging long-term monetary debasement. Finally, we have the classic narrative. Bitcoin as a hedge against long-term inflation and money printing. Bitcoin's supply schedule is hard-coded. Roughly every 4 years, the block reward is cut in half. In April 2024, the reward dropped from 6.25 Bitcoin per block to 3.125 Bitcoin per block. That was the fourth halving. By now, more than 95% of the total 21 million Bitcoin supply has already been mined. New supply is slowing to a crawl. Some recent studies using careful econometric methods argue that the 2024 halving had a positive causal impact on Bitcoin's price in the months afterward, after controlling for other factors. Of course, that does not guarantee future returns, but structurally, it means the following. Fiat currencies like the dollar are designed to inflate slowly over time. Bitcoin is designed to become more and more scarce over time. Over many years, not weeks, that makes Bitcoin a potential hedge against long-term monetary debasement, rather than a hedge against short-term stock market corrections. What could push Bitcoin higher in the next few years? Now let's talk about the upside. What forces could realistically keep pushing Bitcoin up over the coming years? I will focus on 3 big drivers: exchange-traded funds and institutional adoption, scarcity and supply dynamics, and real-world usage. First, massive ETF demand and institutional adoption. The big structural story is simple. Wall Street finally got a clean, regulated way to buy Bitcoin. In January 2024, the United States approved spot Bitcoin exchange-traded funds. On the very first day, the new ETFs did more than $4.5 billion of trading volume. Since then, inflows have been huge. Within about a year, U.S. spot Bitcoin ETFs had attracted tens of billions of dollars in net new money. Some estimates put that number at over $30 billion in their first year. Some of the biggest ETFs, like BlackRock's iShares Bitcoin Trust, rapidly reached tens of billions of dollars in assets under management, making them some of the fastest-growing ETFs in history. By mid-2025, reports showed cumulative net inflows into U.S. spot Bitcoin ETFs around $50 billion or more, and Bitcoin reaching new all-time highs well above its previous peaks, with ETF demand and large long-term holders named as major drivers. This matters because ETF flows are slow, steady, and structural. They open Bitcoin to pension funds, financial advisors, and conservative institutions who previously would not or could not deal with crypto exchanges. They also reduce friction for everyday investors who are comfortable buying an ETF in a brokerage account, but not comfortable wiring money to an offshore exchange. So, even if retail hype cycles come and go, ETF demand can act as a long-term tailwind. Second, scarcity, halvings, and supply dynamics. We already talked about the 2024 halving. The block reward is now 3.125 Bitcoin per block, and more than 95% of all Bitcoin that will ever exist has already been mined. Historically, past halvings have often been followed by big bull markets, with many analyses pointing to strong average price increases in the months and years after halvings, even though the path is always volatile and nothing is guaranteed. Going forward, if ETF demand stays strong, if long-term holders keep accumulating, and if new supply continues to shrink, then even modest new demand can put upward pressure on price over a multi-year horizon. Again, this is not a promise. It is a structural reason why many people believe number go up is not purely random. Third, real-world usage in payments, remittances, and financial rails. The third driver is utility. We are seeing growth in the Lightning Network, which is a second-layer payment system built on top of Bitcoin. There are more Lightning nodes, higher payment volumes, and a rising share of Bitcoin payments being made over Lightning channels. Companies like Strike and others are expanding Lightning-based Bitcoin payments into Europe, Latin America, and other regions, with a focus on cheap cross-border payments and remittances. Every time someone uses Bitcoin to send money across borders more cheaply and quickly than traditional remittance services, every time a small business accepts Bitcoin over Lightning to avoid high credit card fees, and every time a person in a high-inflation country moves part of their savings out of a weak local currency and onto crypto rails, that adds a small layer of real-world demand. This is important. It means Bitcoin is not only a speculation chip, it is slowly becoming infrastructure, a network that actually does things that banks and card networks sometimes cannot or will not do easily. Over time, that kind of utility can support higher and more stable demand, even if speculative hype cools down. Let's wrap this up in plain English. First, why Bitcoin does not hedge stock market crashes. In big crashes like March 2020, stocks and Bitcoin both tanked. Bitcoin often fell harder. Multiple studies from the International Monetary Fund and from academics show that since 2020, Bitcoin has behaved more and more like a risk asset that moves with equities, especially when investors are in a risk-off mood. So historically, Bitcoin has not been a reliable hedge against stock market drawdowns. Second, when Bitcoin can hedge. Bitcoin is much better seen as a hedge against currency and system risks. It can hedge against currency collapse and high inflation in fragile economies. It can hedge against capital controls and restrictions on moving money across borders. It can hedge against payment system failures when banks or card networks are expensive, slow, or unreliable. And over the very long term, its fixed supply and repeated halvings make it a potential hedge against slow, steady monetary debasement. Bitcoin is not crash insurance for your tech stocks. It is closer to system-level insurance. Third, why it still might go up. Over the next few years, Bitcoin's upside could be driven by huge ETF inflows and institutional adoption, ongoing supply reductions from halvings and high long-term holding, and growing real-world use cases in payments, remittances, and high-inflation countries. None of this removes the risk. Bitcoin is still volatile, still speculative, and still sensitive to global risk sentiment. But if you clearly understand what it actually hedges and what it does not hedge, you can use it much more intelligently in your own strategy. If you found this breakdown helpful, let me know in the comments. Do you think of Bitcoin as a hedge for your portfolio or as a long-term asymmetric bet on a new kind of money? And if you want a deep dive video where I compare Bitcoin to gold, to stocks, and to stablecoins side by side, hit like, subscribe, and tell me in the comments. I can make that the next episode.